All right, let's break it down with Jeffrey Palma. He is global equity strategist for UBS Securities. He's in Stamford, Connecticut. And Joe, Jeff, you take a look at the chart. It's pretty amazing looking at the S&P chart, the slow, steady climb up. And we've been hearing a lot about inflation the last few weeks. I'm not sure that would dissuade anyone from going into equities. I mean, what do you think about buying equities as a hedge against inflation?
Well, I mean, I think for the short period of time when inflation's moving from deflationary sorts of levels up towards relatively low levels of inflation, it's an okay thing. I think as a hedge is a bit of a tough concept. I mean, we don't find that valuations hold up particularly well in very high inflationary periods.
Let's bring in Alan Knuckman, senior market analyst over at Agora Financial. He trades commodity futures at the CME Group in Chicago. Great to have you back with us. Let me ask you, Alan, what do you make of, a 4-point gain here on the S&P 500, but again, if you look at the volume, it's pretty mellow here.
Yeah, it has been for a while. It continues to climb. We're getting very, very shallow sell-offs, and we just continue to drift higher, drift higher. It's hard for anyone to remain short this market, obviously, and so you're seeing it slowly inch up. But, it's continue to be positive, and that's a healthy sign. Right now, it's hard to be a buyer at these levels. Maybe if you're going to buy individual stocks, you could buy puts at the same time because the volatility is very low and you can get that cheap insurance.
You sound like you'd be a little bit more comfortable if we took, a few points off of this or a few percentage points off of the gain. Would you, Alan?
Well, I'm looking for the S&P to get to 1,400. Initially, that's been my objective here for the past month or so, and we're only 5% away from that right now. I think there are better opportunities in some other areas possibly. You've got to find individual stocks that haven't participated in the rally. If you look at something like American Express or Visa, that particular sector, if you view the XLF, the financial sector, just made new highs last week. So it's really been lagging behind. So those stocks have some room to catch up, and I really like the chart in American Express. If it gets about 47, we could have a quick move to the mid-50s.
Let me just pull up once again the full year chart of the S&P, because I think it's pretty amazing if you take a look at the climb here. There you see on the right side of your screen. I mean, it seems almost unstoppable. And while we've had some positive economic data, Jeff, we haven't had fantastic economic data, even though most bullish of forecasters thinks unemployment's going to be over 8% until the end of 2012. So not until 2013, which seems like forever away to me, do we move down to 8% or lower. Why this climb here, especially after the fantastic year that we had in 2009 and okay in 2010?
Well, I think a couple things. Number one is we got to remember, people were talking about double dips in July of last year. People were concerned about the sustainability of this economic recovery. And very clearly, our economic surprise index bottomed at the end of August of last year, right when the correction in markets ended. And as that number has moved higher consistently for the last 5 months, equities have moved higher as well. I think that's been a really important source of support for the markets, but so too have earnings. Earnings growth was 40% last year for the world. It's been an unbelievable recovery for the corporate sector, even in a pretty slow GDP environment, and I think we have to recognize that that's been a very, very important driver of the market.
Jeff, getting back to this inflation versus stocks issue, it's not versus so much, it's because of. I mean, isn't it true you want to be in stocks right now?
Jeff?
Yeah, I'm sorry?
No, go, please answer.
It's true when you're starting from very low levels of inflation and worries about deflation, and you're moving up to low and stable rates of inflation. And so while you're going from sub 1 to 2 or 2.5, I have no problem with that view. If we're talking about inflation pressures, core inflation up towards 3 and 4, and you start talking about the 1970s all over again, then I disagree. But over the last 2 years, deflation is by far the worst outcome between inflation and a little bit of deflation and a little bit of inflation.
I mean, and Jeff, you're not expecting any kind of inflation of 8, 10, 12%, are you?
No. I mean, we're talking still, pretty large output gaps, high levels of spare capacity. We think inflation will move up to the low 2s. I think that would be a perfect outcome, and that's really what the Fed is trying to engineer here.
Although when you see in the past, as soon as the genie's let out of the bottle, it's very different. I know that Ben Bernanke said on 60 Minutes he's 100% sure of the Fed's ability to deal with this problem, but there are a lot of people who are more skeptical than that.
Well, look, there's no such thing as a sure thing. There's uncertainty around it, but I think we can rest assured that the Fed intends to start taking back some of the liquidity that it's provided. We think they'll start raising rates in the first part of 2012 in the initial stages of that process.
Alan, what's going on here? You're a trader. If you look at these converging, diverging signs here, there's a lot of confusion out there, yet this market keeps on going up. I'm looking for a catalyst to make it go down. What's that going to be?
It's been harder and harder to find trading candidates recently because a lot of the easy money's been made. We're up here at a very lofty level, and you're getting some signs. You're getting some of these signs of consumer confidence. You're getting the fact that money actually was a positive inflow into stock index funds last month. You're getting a sign that people are coming off of their couches and participating in this rally. And as a contrarian, that's oftentimes when the rally comes to an end. So right now it's about controlling your risk, and that's where I come back to using puts because they're so inexpensive. You can buy a stock and buy a put as an insurance, and that way you can ride through some ups and downs for the next few months and see if there's going to be a profit-taking wave, and if there is, use that as a buying opportunity.
We've also got the VIX staying down at pretty low levels, down at 16. I mean, Jeff, doesn't this at some point say to you too much complacency in the market? We've had tremendous gains. It's time to definitely take some money off the table here.
Well, again, I think there's been a lot of fundamentals behind it. We have an equity risk appetite index that we track. It's definitely moved up from where it was from the lows. It's still hovering a little bit below those extreme risk territories, though, that we tend to get nervous about. For sure, with volatility where it is, we're getting closer to those points. But that's been one of the reasons that since we've stayed below that level, that we haven't really been so concerned about the tactical risks so far.
Let's bring in some sound here because we heard from Lazard Vice Chairman and Managing Director Gary Parr earlier today on the power of cash or lack thereof. Listen in.
Now that it seems we're through the really difficult issues of a financial crisis, cash is just a dead asset. It's earning nothing. And so that, in the end, is our advice. We'll look at the financial consequences of having a dead asset versus deploying it.
Well, first of all, Jeff, do you agree? It sounds pretty clear, but if you do agree, then what do you do with that cash? Are equities the right place to go? We haven't talked about commodities yet, and they've had a pretty fantastic run.
I think there's two interesting ways to think about it. One, from the investor standpoint, is, yeah, cash is earning us nothing, and we do still find equities are probably the best relative value trade across the asset class spectrum. I think the other side, though, is the corporations that are sitting on piles of cash are also being forced to deploy it. They need to relever their balance sheets. They need to spend. They need to invest. They need to pay more money out to shareholders. So I think we're seeing cash being deployed simultaneously in a couple of ways.
Hey, Jeff, a quick question. We've probably only got about 20, 30 seconds, but these next stress tests that the banks are going to face, is that a concern? Should they keep some of that cash, or you think they're fine and they can deploy it as well?
I should be pretty clear, right? We're talking about the non-financial corporate universe, right? The financials definitely have to have higher capital requirements to meet Basel III needs, to meet other regulatory needs. It's going to be a little harder and slower for the financials to repay some of that, but it will happen in some instances for sure.
All right, Jeff Palma, Alan Knuckman, guys, thank you so much. We appreciate you walking us through the close on this Thursday.